We were pleasantly surprised in the second half of last year in the U.S. how quickly inflation fell. It gave us a lot of optimism that maybe it would go all the way back down to our 2% target. But then in the beginning of this year, just as Chairman Powell said, it has moved sideways. And that's raised questions in my mind. Is the disinflationary process continuing, or are we landing to more of a 3% inflation level? I think it's still too early to know, and we need to wait and see to get more confidence.
Markets have been disappointed all year. They had a lot priced in as we started out the year. They've been guided back to about 1 to 2 rate cuts so far this year. You said at Milken the other week that you couldn't rule out a rate hike, even though the bar for that was still high. Now you've seen a bit more data. You've been closely looking at the economy. Can you rule out a rate hike?
No, I don't think I don't think we should rule anything out at this point. We are all committed to getting inflation all the way back down to our 2% target. The most recent inflation print that we got on the CPI data was marginally better than the earlier prints from the first 3 months, but still not where we need it to get to. So it wasn't getting worse, but we just need to wait and see. I think right now we're in a good position because the labor market remains strong in the U.S., so we have the luxury of being able to sit here until we gain confidence on where inflation is headed.
So what we're seeing is a body of water between your commentary and the market expectations. What is it going to take, in your view, to get us to 1 to 2 rate cuts this year?
Well, a lot more, many more months of positive inflation data, I think, to give me confidence that it's appropriate to dial back. You know, the U.S. economy has remained remarkably resilient. GDP growth has been strong, much stronger than forecast. Most people thought that we'd be in a recession toward the end of last year. That didn't happen. Instead, we had very strong growth. U.S. consumers have remained remarkably resilient. The housing market has remained resilient. So I'm not seeing the need to hurry and do rate cuts. I think we should take our time and get it right.
Neel, it's clear then that interest rate hikes haven't necessarily worked as effectively as they may have in the past. Does that worry you at all, that maybe we need to give the Fed more tools, or that the Fed needs to do more in future in order to get inflation back down to whatever target it may be, which of course currently 2%?
I'm confident that we have the tools to get inflation back down. What's unclear to me is maybe some of the dynamics of the reopening of the economy has raised what I call the neutral rate, or what we call the neutral rate, the policy stance that is the minimum level that we need to get to, where we're not stimulating or restraining the economy. If that neutral rate has gone up in the short run, then that means the policy would need to be even higher in order to get the inflation back down to 2%. That's very unknown right now. It's very hard to judge that in real time. And so I think we just need to take more time to assess where the economy is headed.
Do you think a lot of that has been hampered by how much spending government has also put in this reopening of the economy, because that's hampered your progress to getting inflation down?
It's one of the factors that has contributed to the high inflation. I think bigger factors are more on the supply side, with the services sector shut during COVID, with Russia invading Ukraine, pushing commodity prices up, and supply chains that have been gummed up. A lot of the supply chains problems have sorted themselves out. That's led to some of the disinflation. The question is, are we going to get all the way back down to 2%, or does monetary policy need to do the rest of the work?